much more risk. But what happened now is that the risk is not on the balance sheet of a lot of these companies. It's been securitized and it's been sold to other investors in this form of mortgage-backed securities. So I think it's been localized. So while you have an industry phenomenon going on, the financial risk is spread not just here in the U.S., but there's consumers of that risk globally. There's people in Germany for pension funds buying mortgage-backed securities. So they understand the risk of what's going on, and it's been sliced up. And the more risk you have, the potential to lose money, and that's what's happened here.
This is really this global trend of what some call financial capitalism, with an unprecedented volume of various securitized loans and derivatives and counterparties and whatnot. I'm not sure any of us understand this game, except I think what you're saying is the system can absorb this. Is that really what you're saying? There's sort of absorber shocks throughout the system?
Right. Let's look at the global economy. We see capital markets have become more integrated, which is a good thing because capital can move to where it needs to be. We've seen correlations go up between the capital markets. And what have we also seen? All the companies or all the countries in the G30 right now are growing positive GDP. And the integration has dampened the business cycle over the last 5 to 10 years. Whether that's sustainable, we're going to have to go through some other cycles to find out. But also capital can flow to where it's most rewarded and most needed. And consumers of that capital and people who can allocate that capital can find risky investments where they need to be. So it's not like the S&L crisis in the 80s where there were banks and communities very heavily impacted by this on a localized level.
All right, that is a very key point, your last point. Let me just ask you one quickie before I get to the others. There's the leveraged loan index, which is down. It looks worse on the chart. It's actually about 5 or 6%. That's all it is. Kevin, are you a seller on a day like today, or are you a buyer?
Well, we're a buyer. We're already underweight the financials, which is good, but there was a lot of great fundamental stories out there. So here's a day when you're down 2%, energy was down 3%, energy's still up 19% year to date. So the fundamental stories don't change in a lot of these companies because of a one-day correction.
Let's stay with the fundamentals. Arthur Laffer, whenever I get a day like today and people start talking about bear and pessimism and doom and gloom, I go back to the basics you probably taught me 25, 30 years ago, actually both you and John. When I look at earnings from the bottom of the cycle in 2001 right through the first quarter, these are after-tax IRS profits. Nobody overestimates IRS taxable profits. Profits are up 130%. And the stock market, the broadest averages, let's take the Wilshire 5000, the Dow Jones Wilshire 5000, is up, I think, 105%. So profits are still running ahead of stock averages, Art. How bad could this be?
Well, you know, Larry, you missed two others, too. Interest rates are down slightly from then as well, and tax rates are down from then as well. So the after taxes, now after personal income tax profits, are up even more than you show. Frankly, I think this is just a glitch in the move. If you look at profits, capitalized profits, and compare them to stock prices, and I use the S&P 500, but you can use any index you like. Stock prices today are still very low compared to capitalized economic profits. The profit numbers coming out are fine. You're going to get days like this when you have a strong bull market. And as you said, the market's way up for the year, and I expect it to continue going up for the rest of the year. All
right, that's interesting. John Rutledge, let me come to you on some credit issues. We have the, I hope, the junk bond spread chart. We can put it up. I want to apologize. I was a little hard on Bill Gross in the last with Melissa Francis and Ron and Sana. I don't think Mr. Gross is touting his book. He's entitled to his view of how the world works, and I was a little hard on him, and I want to apologize. But let me just say this. The widening of the junk spread to Treasuries, we haven't quite seen it yet on the board, we've got it someplace, is a very small amount. Okay, there's the historical chart. Over the past 5 years, that junk spread has gone from over 1,000 points to slightly more than 300 points. Now, if you go to the lower right hand of that, we can blow that up in our next chart, which gives you the year to date, okay? It has gone up, that spread has gone up, what is that, about 75 basis points, but that's all. That is a relatively narrow spread, John Rutledge. So I want to make the case, maybe I'm going too far, that actually credit indicators are just fine, even though there are some ripples of worries through the market. John Rutledge, are we facing a credit disaster, a credit crunch, a loan crunch?
No, it's always worth looking for, but no evidence to date, Larry. This is not a bubble. Bubbles are when something is too expensive. This is a market that was underpriced going to fair value. Nothing happened today. I know the guys at Countrywide, Angelo and the guys, they're great, smart managers. The housing market, mortgage market sucks. Everybody knows it. This is not big news. The only two things we do know that are news is last night we had a YouTube invasion of politicians who all want to do protectionism, tax the rich, tax private equity, and so forth. And today we have people being afraid in the market.
Do you think that
there is some tightening on credit terms in the bond market?
We're going to have John Harwood on in a second to go through that debate. But since you've unlocked this baby, you've let the cat out of the hat, you've let the horses out of the barn, John Rutledge, you don't suppose that the sum total impact of that debate helped lead to today's sell-off, or are you supposing that?
Well, I think it certainly didn't help. We heard some people hate the rich. We heard other people hate the private equity industry. We heard other people hate Chinese and international trade. It was like a hate festival. I don't see how that's going to help capitalize profits in any way.
I agree with John entirely, by the way, Larry.
Well, all right, Tim Weiner, take us out of this, Tim. I know you think there's a bubble coming, and I appreciate all points of view, especially on a day like today. But I did some back-of-the-envelope stuff, Tim. On a trailing 12 months, Eric Weiner, on a trailing 12 months, the price-earnings ratio is 18 times. At the peak of the last market, which was 2001, and I acknowledge there was a tech bubble and interbubble, you know what the trailing 12 times earnings were? Take a guess.
Not sure. You'd have to tell me.
46 times. Price earnings was 46 times on a trailing 12-month basis. Today, on the S&P 500, it is 18 times. Moreover, with 5% earnings growth in the next year, which is a middling forecast, the forward price earnings multiple is only 16 times, Eric. It just doesn't seem like it's bubbling over to me.
Well, not necessarily right now. The market looks ahead. So if you look at the credit spread chart that you showed right now, it doesn't necessarily show that a market is bubbling over. But if you look at some of the anecdotal evidence like Alliance Boots, like Allison Transmission, like the Expedia buyback, now you're talking about some possible bad news for the credit markets. And that's where the market goes, uh-oh, where are we going?
Well, I appreciate that. And I also appreciate the importance of corrections, because that keeps the wall of worry high, and that, I think, keeps markets honest. Anyway, hang on, everybody. Our panel is sticking around. They've got a lot more work to do. Coming up, who won the Democrats' debate last night? We already heard John Rutledge's verdict. What I heard, if any of them are elected president, the loser could well be the stock market. And then we're going to look at $100 oil. That's what some Wall Street firms are saying. But you know what? Oil was down today, and gasoline is down, and natural gas is down. And I'm going to speculate that crude oil may be heading for a big fall. We're going to debate the oil proposition. We're also going to talk to Dan Gross. He says the sinking dollar has an upside. But our dollar bear, Michael Darda, is shaking his boots with worry over the greenback's weakness. We'll talk to a sponsor, by the way, of a bill that would force public pension funds to get rid of shares of any foreign companies doing business in Iran or North Korea or Sudan or Syria, and I think that is a heck of a good idea. We've got ourselves a New York State senator who's proposing that bill, because we are for keeping America great, we are for keeping America safe and profitable and prosperous. Kudlow and Company coming right back. We are indomitable bulls this evening, and you are watching CNBC, first in business worldwide.
I believe